Income insurance. Disability income insurance helps preserve the continuation of a business if an owner, partner, or key employee is disabled. Key person disability income policy. A business could suffer devastating, even fatal consequences, if a key employee, partner, or shareholder becomes disabled and can no longer contribute to it. To protect itself, a business can buy a disability income policy on a key employee, partner, or working shareholder. The business owns the policy. If the insured becomes disabled, the benefits are paid to the business. The business can use the funds for any purpose. Example: a business that receives benefits from a key person disability income policy can use the funds to replace some of the profits lost due to the key person's disability. The funds can also be used to attract and train a replacement for the disabled key person. A key person disability income policy benefits only the business that owns the policy. It does not pay any benefits to the key person and does not reduce the key person's need for personal disability income insurance. Disability buyout policy. A business disability buyout policy provides business owners with the funds needed to execute a buy-sell plan. If an insured business owner is totally disabled, the policy provides the funds needed to buy the disabled owner's interest in the business. Although a business disability buyout policy can pay a monthly benefit, it is more common for the benefit to be paid in a lump sum. That money is then used to buy the disabled owner's business interest. Buying out an owner's interest in a business is not to be done hastily. For that reason, the elimination period of a buyout policy is much longer than with any other type of DI policy, 18 or 24 months, or even longer. The elimination period in an individual DI policy is usually 90 days. Unlike an individual DI policy, a business buyout policy does not require the insured to remain disabled beyond the elimination period before the benefit is paid. The benefit is payable if the insured is totally disabled at the end of the elimination period, even if the insured later recovers. A disability buyout policy pays a benefit only if the insured is totally disabled. Partial disability does not qualify for a benefit payment under a disability buyout policy. A DI buyout policy usually pays its benefit in a lump sum. If the disability outlasts the elimination period but the insured recovers, the insurer cannot get its payment back. The buy-sell agreement that the policy funds determines the benefit, elimination period, and whether the benefit will be paid monthly or in a lump sum. Depending on whether the agreement is an entity purchase plan or a cross-purchase plan, the business may own the policy, or the other partners or shareholders may own it. Key point: in an entity buy-sell agreement, the business buys a DI buyout policy on each owner. This is suitable for a business with many owners. In a cross-purchase buy-sell agreement, each business owner buys a DI buyout policy on each of the other owners. This is suitable for businesses with a few owners. Business overhead expense policy. Business overhead expense, BOE, insurance is designed for small businesses concerned about paying the overhead costs of operating the business while the owner is disabled. A BOE policy covers overhead costs, such as rent, utility bills, insurance, and taxes that can ruin a small business if the owner is disabled and unable to run it. Even the salaries of the owner's employees can be covered. Only the owner's salary cannot be covered with a BOE policy. The owner would need his or her own DI policy for that purpose. Unlike buyout policies with long elimination periods, BOE policies have short elimination periods, such as 15 to 60 days. They also have short benefit periods, usually 1 to 2 years. The benefit amount is determined when the policy is purchased. The greater the benefit amount, the higher the premium. BOE policy benefits are paid on a reimbursement basis. The business owner files a report monthly with the insurer showing the amount and type of overhead expenses paid. The insurer then pays eligible overhead expenses up to the maximum monthly benefit amount. The insurer will pay eligible overhead expenses that exceed the policy's maximum monthly benefit amount in future months if the insured's disability continues. Disability reducing term insurance. Disability reducing term insurance covers outstanding business loans when the business owner becomes disabled. A business owner buys a disability reducing term policy to cover the term of the loan. If the owner becomes disabled during this term, The policy makes monthly loan payments as they come due. Benefit payments correspond to the reducing balance on the loan. Therefore, these payments diminish over the policy's term. Key point: do not confuse disability reducing term insurance with decreasing term life insurance. While both cover the declining balance on a mortgage or other loan, disability reducing term insurance pays benefits upon disability while term life pays upon the insured's death. For your review, a key person disability income policy does not reduce the key person's need for personal disability income insurance protection. It benefits the business alone. The elimination period of a buyout policy is usually much longer than in any other type of DI policy. A DI buyout policy benefit is payable if the insured is totally disabled at the end of the elimination period. Disability buyout policies pay a benefit only if the insured is totally disabled. Although a BOE policy pays the overhead costs that a small business incurs during the owner's disability, including employees' salaries, it does not cover the owner's salary. The owner must get a personal DI policy to cover his or her own salary. BOE policies have brief elimination periods, 15 to 60 days.
This course, we've made the point that in the business market, the products that are used to meet business insurance needs are typically the same as are used in the personal insurance market. When it comes to disability in the business market, that's not exactly true. And in fact, there are several products that are designed specifically for the business market when it comes to disability, and I want to talk about those just for a moment. And they are the disability buyout policy and the business overhead expense policy, or BOE policy. Let's talk about the disability buyout policy first. If you remember the basics of an individual disability income policy, you know that it typically has an elimination period that, maybe 6 months to a year at the most, usually much shorter than that. And that's a period of time that must elapse before the benefits become payable. Also, we know that with an individual disability income policy, the benefit is paid in the form of monthly income because it is in effect replacing lost income. The business disability buyout policy is different. It is used to fund a buyout agreement, disability buyout agreement, which is similar to the buy-sell agreement that is used in life insurance, except, as you would imagine, it's used in the event of the total disability of the business owner. Because the business owner wants to make sure that, in fact, the disability is total and permanent, disability buyout policies typically have a very long elimination period, typically 18 to 24 months, maybe even longer. The reason for that is quite simple. A business owner wants to make sure that, in fact, before the transfer of ownership of that business is effected, he is, in fact, totally and permanently disabled. Another unique characteristic of the disability buyout policy is that it pays its benefit in the form of a lump sum payment, not periodic income. If you are the incoming owner in the agreement, you want to be paid in a single lump sum. You do not want the payment proceeds paid out over a period of time. So buyout policies typically have a very long elimination period, and they pay their benefit in the form of a single lump sum payment. Business overhead expense insurance, BOE, is also a unique form of disability insurance, and it is unique in two respects. Number one, unlike a disability buyout policy, a BOE policy has a very short elimination period, possibly a week or 2 weeks, at most a month. And that's because the purpose of the BOE policy is to keep the business running while the business owner is disabled. And missing expenses even for a month can be devastating to a small business. So unlike the buyout policy that has a very long elimination period, BOE policies have a very short elimination period. Another unique characteristic of the BOE policy is that it pays benefits based on a list of expenses that are identified when the policy is issued, and those expenses are the basis of what's paid out. That differs, of course, from an individual DI policy that bases its payment on the lost income of the disabled individual. So BOE policies are characterized with a very short elimination period and benefits that are based on a list of expenses. And one final note on those expenses. The business owner can list as many different expenses as he would like to be covered, but the more expenses that are listed, the more expensive the policy is going to be. Also, the BOE policy can cover employee salaries, but a BOE policy cannot cover the business owner's lost income. For that, the business owner needs his or her own individual disability income policy.
Okay, here is the 4 questions for this lesson. And he just stated this one. I bet y'all, let's see, I'm betting I'll get it right. Let's see. All right, a business overhead expense policy differs from disability buyout policy by, what did he say? I cannot remember. Oh my God, I wasn't paying attention. All right, I'm going to guess. I remember him just saying that too. Okay, which statement best describes the purpose for a business owning a key person disability income policy? Reduce the key employees' need to buy, provide key employees with fringe benefits, provide the business with funds to use for any purpose, provide a key employee with the funds needed to buy the business. No, that's not it. Reduce the key employees' need to buy a person with disability, provide the business fund, provide with funds to use for purpose. I want to say the last one. All right, what kind of insurance policy pays benefits to the business owner if an essential manager were to become disabled? And they only given us 3 questions. That's the first. Key person. If the essential manager were to become disabled. Let's guess that one. All right, let's see how we did. 33%, which means I only got one right. So I got the last one right. Key person disability insurance policies on key employees, partners, working shareholders if the insured becomes disabled. A BOE policy differs from disability buyout policy, having a shorter elimination period and a longer benefit period. Unlike buyout policies with long elimination periods, BOE policies have short elimination periods, such as 15 to 60 days. They also have short benefit periods. Number 2 I got wrong as well. The answer for this one is the purpose for business owning a key person disability income policy is to provide the business with funds to use for any purpose upon a key employee's disability. I mean, that makes sense. I would think a fringe benefit would also be nice, but they said no. Okay, that's it on this video. It's not super long. It was right perfect, right in between. So stay tuned. We're doing social insurance disability benefits next. If you need help in that area, be sure to tune in for that video. Thanks, everybody.